lot of investors assume that a stock is less risky if the price is rising because it looks solid and others are buying it. So they think it must be a good buy. We feel safe with the crowd, but actually in many cases risk increases as the price rises and decreases as the price falls. There's a great video by the YouTuber Meet Kevin, put a link in the description, where he shows money flows into and out of ARK Invest ETF. It showed that as Tesla's price fell, people withdrew money from ARK Invest, and as the price of Tesla rose, they put money back in, which leads to people buying the tops and selling the bottoms, which is the opposite to what we want to do. Following the crowd is definitely hardwired into us. Following the crowd allows us to function in a complicated environment. Most of us do not have the time to increase our knowledge of complex subjects, so instead we rely on other signals like popularity. It's known as the bandwagon effect. On Wikipedia it says the bandwagon effect is the tendency of an individual to acquire a particular style, behaviour or attitude because everyone else is doing it. More people buy leads to more people buying, regardless of the quality of the stock or supply and demand or anything else. But definitely selling with a plan to buy lower, whilst it sounds good, can cause a strange psychological trap. First thing to acknowledge is it's impossible to know in real time if you're going through a pullback or a more sustained downtrend. If the market's been going up and it's starting to look like it's rolling over, people may say, the market's crashing now. And so you may be tempted to sell. But if you do that and you realise after the fact that that was just a pullback, in fact you should have been buying there. But of course it could carry on going down. The point is we never know. So that's the first reason why trying to time the top to sell at the top and try and buy lower down is so difficult. But there's another reason that's a little more tricky. Let's assume that you think the market's going to go through a sustained downturn. You want to sell your shares here and buy back lower. This causes a few problems. First of all, when you're selling, other people may see it as a bargain and you end up just selling the bottom. But even if you're correct, let's assume the price continues to go down. Right now you're feeling great because you know you can buy back and make the difference between where you sold and where you buy back. But when do you buy? Most people want confirmation that the market's going to go back up before they buy. They don't like to buy on red days, so effectively you will then be in a situation where you're buying back around the price that you got out. In a worse scenario, this could happen. You could be right for a very short period of time and then wrong immediately. And this causes another problem because you know that you're out of the money by this amount and it's a horrible feeling. You would have done better to just do nothing. And you're telling yourself, why didn't I buy more shares? And it's very hard to know what to do. So in this scenario, a lot of people don't want to buy back in. So they miss out. They want to wait for another pullback. If it pulls back, they may actually get in at the price they got out of. But, more times than not, this happens. And it runs away with you. So people then think, oh gosh, I'm just going to buy in now. And you know what happens then? It comes down. This is why it's very hard to time the market, especially the tops and bottoms. The reason it's riskier as stocks go higher is because we can all see the same thing. As the stock meanders up, people take on more risk. People become exuberant. They think it's going to go up and up forever, so they take on more margin. So as we get higher, things get more volatile. And all it takes is, a hint that this could be the top and everyone wants to sell. A, because they want to lock in their profits, but B, because they're in a much more precarious position. And, everyone can see this huge potential drop. It's visual. And that's why things are slightly riskier as they go higher and higher without a pullback. In 1999, when the dot-com bubble got bigger and bigger, the Nasdaq was up over 85% for that year alone. You can see in this chart, it's just went parabolic. Then in the first quarter of 2000, there was bigger than ever inflows buying. This just shows how people just like to buy with the crowd. Soon after, it fell 50% and people couldn't sell fast enough. And I'm not going to say that's the wrong thing to do. You know, this is a rare example of a 50% correction, and perhaps that is the right time to sell. But we never know. And long term, let's have a look at the long term chart. You can see the top of the dot-com bubble was there. So holding long term, you would have been quids in. But of course, it would have taken, this was a 10-year sideways movement. Looking at this chart makes you wonder if the Nasdaq is actually a bit too parabolic at the moment. We don't know if the circumstances are the same now. That's for another video. It's very different with the QE that's going on now. So this could sustain a lot longer. Who knows? But anyway, the point being that aside from these huge crashes, all these other little pullbacks where probably a lot of people tried to time the market, it wouldn't have worked. It would have been better just to buy and hold. Investing, either swing trading or long term, is risky, so don't take my word for it. Do your own research and invest safe.